Ladies and gentlemen, welcome to a new podcast of Grant's Interest Rate Observer. I am Jim Grant, and with me today, as usual, is Eric Whitehead, who's on the controls. He is our engineer, and the great Evan Lorenz, deputy editor of Grant, is also on the scene. I think in the background, not so far, is Philip Grant, the associate publisher of Grants and the author of the Almost Daily Grants. That leaves Saturday and Sunday most weeks for playtime. But hey, Evan, I wanted to begin by, first of all, by acknowledging our kind sponsor, Pitney Bowes, and secondly, to observe that this episode is also sponsored in the way of Sesame Street by the word somewhat. Get around to that in a second. But we have a quality of earnings discussion, do we not?
That we do. Whirlpool, the Grants Bent Noir from Benton Harbor reported earnings today as we were recording right now. The company reported a miss. Its adjusted EPS came in at $3.35, and the street was expecting $3.53. However, if you peel down below the first couple sentences in the press release, GAAP earnings actually came in at $2.52, well below the non-GAAP numbers. And in fact, over the last year, Whirlpool's earned $9.99 in GAAP earnings, the audited kind that the auditors approve of, versus $13.84 in the non-GAAP variety. The quality of Whirlpool's earnings seems to deteriorate as time goes on. Just to give an example, they backed out $59 million in restructuring charges in the most recent quarter versus $40 million in the same period a year ago. The restructuring charges are all related to an acquisition Whirlpool made in the fourth quarter of 2014. So this acquisition that's now 2.5 years into corporate history is accruing larger and larger restructuring charges as time goes on. Also, the company has been guiding the street for a full-year tax rate of 20%, when in fact, in this quarter, they came out with a 15% tax rate, well below the statutory U.S. tax rate of 39%. You would expect the company to pull out all stops. In June, they announced that the longtime CEO, Jeff Fettig, was going to retire on October 1st, so this was his last quarter as the CEO of the company. With that said, again, they still had a material miss, and this is not something that's really new with Whirlpool. If you look at the last 4 quarters, the company has missed adjusted EPS guidance and consensus every single quarter for the last 4 quarters.
Now, how does the market react to this? The stock is, I mean, we are bearish on it, but I can't help but observe the stock is not paying attention to what we want it to do.
The stock is down 7% today, but it's approximately around the same place that we published on it on February. And again, because the gap between audited numbers and adjusted numbers is so wide, the valuation on it is either very cheap or very expensive, depending on your perspective. So based off of the adjusted numbers that the street believes in, and that if you go to Bloomberg, you'll see when you pull up the description page, the stock's trading at 12.8 times earnings, which compared to a overall stock market trading at 20 times seems relatively cheap. But then if you actually look at the real numbers, the numbers that auditors approve of, the stock's trading at 17.7 times, which seems expensive for a company that's missing earnings every single quarter, that has low quality of earnings, and other problems that we've identified in our piece in February.
You know, Whirlpool is not exactly unique in this regard, no?
No, it seems like one of the hallmarks of our current bull market is, as time goes on, the adjustments to earnings and the items that management finds one time increase for a whole range of companies. But the thing is, it's almost invisible to most people looking at the market, because again, the Bloomberg terminal by default shows you adjusted earnings, and they don't even tell you that they're adjusted earnings. So when you pull up any single company, whether that's Kraft Heinz, Whirlpool, Restaurant Brands International, you'll see a number that looks, somewhat pleasing, maybe a little bit expensive. But then when you start digging into the financials, you'll find that the earnings, the valuation is actually much more expensive on, GAAP numbers.
And the index makers pick up where the chief financial officers leave off. QQQ Trust Series is a Power Shares exchange-traded fund that tracks the NASDAQ 100, an index of the 100 biggest NASDAQ-listed non-financial companies. QQQ's great star performers of the bull market have a price-earnings ratio, according to the authorities, to the Power Shares people, of 22 times or thereabouts. 22 times. And you scratch your head. Steve Bregman has helped us scratch. He, in fact, created the itch that made us scratch. He's a very curious fellow and a very fine analyst. But you wouldn't expect this, the top 5 index constituents being Apple and Alphabet and Microsoft and Amazon and Facebook. They constitute 43 or so percent of the index market value when they trade. These stocks do at a weighted average multiple of about 57 times. So you wonder, how the heck can the QQQ claim a multiple less than half the grand total of so large a constituent sample? Well, it can, and here's how it does. In the first place, again, thank you, Steve Bregman, the QQQ price earnings ratio calculation excludes the results of loss-making companies. Now, that is not unique to this QQQ exchange-traded fund. The NASDAQ Biotech Index, for example, does the same. But the real source of the prestidigitation, which, Evan, that is a kind of a magic trick. The source of this magic is the calculation method of the price-earnings ratio. And you could think of all manner of ways of doing this. You could add up the PEs of different companies and divide them by the number of companies. You could add up their earnings and then take their average price and do it that way. But here's the way that the PowerShares people do it. They use the weighted harmonic mean. And a footnote on the Invesco website explains it this way, quote, a method of calculation using an average value that lessens the impact of large outliers and increases the impact of small ones, close quote. Well, we fall back, as we so often do, to that final authority, Wikipedia, which furnishes a more granular, if not more immediately clarifying description as follows, quote, the harmonic mean can be expressed as the reciprocal of the arithmetic mean of the reciprocals of the given set of observations. What? Well, okay, so let's work through this slowly. Everyone get out his or her pencil, please. This is going to take a little bit of work. Now, not much. Now, we're going to take the hypothetical portfolio of 4 equal weighted stocks. And let's say they're valued at 10 times, 20 times, 30 times, and 300 times earnings. So you divide the sum of those 4 PEs and you divide by 4, and the answer is 90. 90. So now you do the first step for the weighted harmonic mean. We call the reciprocal is 1 divided by the quantity. So sum the reciprocal of the what you do is take the reciprocal of those and you add them up and you get 0.1867. You divide by 4 to find the average. Next, you take the reciprocal of this product, or 1 divided by 0.0466. That comes to 21.4. Thus, a basket of stocks that has an equal weighted average earnings multiple of 90 times becomes a weighted harmonic mean multiple of 21.4 times. Got that, Evan?
It sounds perfectly preposterous.
I want to say hello to my friend Jack Bogle. This is a pure index investment approach, which he pioneered. John C. Bogle invented. He's the founder, of course, of Vanguard Group, is to invest in the stock market, the whole stock market, and nothing but the stock market as mimicked by the S&P 500. You can do this for pennies in the dollar. Start young, don't stop, and you may have the pleasure of dying rich, too. Okay, that's one way of doing it. That's the Bogle way. The ETF approach, as typified by the $55 billion QQQ, is a little bit different, and that is invest in a particular segment of the stock market, and necessarily concentrated in probably hot segment. Cleverly time your entrance and exit, and repeat for as long as your capital holds out. That's the ETF approach. This episode of the Grants Podcast is brought to you by our friends at Pitney Bowes, the makers of SendPro. Now, did you know that compared to BrandXStamps.com, SendPro has 3 times the features at 1/3 the price. You can print stamps at your computer and call it the Internet of the Stamps, or, wherever. If you want to wait in line with the post office, Pitney Bowes has nothing to stop you. But with the SendPro, you can print paid shipping labels for the U.S. Postal Service, UPS, and more. You can track your shipments from the same easy-to-use interface, and you can save money. Pitney Bowes has negotiated special rates for SendPro users with savings starting at 3 cents per stamp. Now, you want to learn more as well, you might. Visit pb, as in pitneybowes.com/grantspod to find out about an introductory offer that features 90 free days of SendPro, along with what the Pitney Bowes people persist in calling a free 10-pound scale, but which we at Grants have weighed out to be what, Phil?
1.6 pounds.
Yeah, it's different from 10. Yeah, but as I recall distinctly saying in a previous podcast that we at Grants are not shills. We are journalists. We are empiricists, and we have tried out this technology for ourselves. Eric Whitehead, who is is our technologist in house. He's in charge of everything that from putting. From changing the paper in the computer in the printer file drawer. I mean, I can't do that. He does it. He does much more complex things than that. But I told Eric, please try out the SendPro. We're not going to talk about this product unless we can vouch for it. So he did. And while we don't do much mailing with the post office, he says, but what if we did, because he tried it, what was really nice about the platform is that everything is actually all in one place. You don't need to go to various websites to print labels for UPS, FedEx, and so forth. And here's a direct quote from Eric Whitehead, who was giving this testimonial without anything in the way of emolument, pay, or bribe. Quote, Eric Whitehead, all your shipping needs are consolidated on one easy-to-use website, period, close quote. Now, so SendPro, Pitney Bowes, and Tom Grant sent you. Indexation, Evan, is very, very big. And ETFation, that's the word, right, is just as big or bigger. And I don't know, it's kind of the way we roll today, right?
Yeah. We did ask the good folks at Invesco PowerShares why they use the weighted harmonic mean and, whether it's an accurate measurement for the index.
Could you give us a dramatic reading?
I'll try to make this dramatic. Invesco uses methods to calculate the P ratio that we believe are best reflective of that P ratio, which includes using industry standard methods such as the weighted harmonic average. There are many different methods for calculating a P ratio, all of which have pros and cons, but the weighted harmonic average is a calculation that is standard across the industry.
Yeah, good. Very nice, very well read, and I would say from the point of view of Invesco, very artfully crafted. Well, this may be the bull market standard, but I'm just going to speculate, and this, of course, is just guesswork, Evan. I'm going to speculate that after the stock market congressional hearings of the year 2018? Yeah, 2018, that we're going to be using the simple arithmetic average. And then we're going to multiply that by 3 just to scare off the retail. That'll be a federal law. It'll be the new, it'll be the Lorenz rule. Never mind the Volcker rule. We're going to get a Lorenz rule to import honesty into the calculation of ETF price earnings ratio. So there's a little prophecy for you. Now, let me see. Oh yes, Evan, I am remiss because I indicated above, that is to say at the top of the podcast, that this particular segment is sponsored not only by Pitney Bowes, our friends at Pitney Bowes, but also by the word somewhat. Now, this might seem a little bit mystifying, but bear with me. The word somewhat was key to a lot of financial inside baseball chatter the other day. The Federal Reserve came out as is its wont. The FOMC came out after its meeting when recently, right?
Yeah, yesterday.
That's pretty recent. And said something to the effect that overall inflation and the measure excluding food and energy prices have declined and are running below 2%. That was a quote. Running below 2%. And what the criminologists following the Federal Reserve and the FOMC particularly noticed was that the month before, that same language ran as follows. It said, running somewhat below 2%. Somewhat. Now, I don't know how many billions of dollars were riding on the presence of that modifying word, somewhat. But we have come to a place in our monetary history, Evan and Phil and Eric, we're coming to a place in our monetary history in which that weasel word is the occasion for serious people betting other people's savings on what? I mean, let us pause and reflect that the complexities and difficulties of calculating a price index are considerable. The prices that these indices contain are sampled. There's sampling errors. There are more or less arbitrary choices made by the samplers about what constitutes the near substitute of that particular product to be sampled, not on the shelf. There is the seasonal adjustment. There is the adjustment for changes in quality, the so-called hedonic adjustment. And I don't mean to suggest there's bad faith on the part of the index gatherers, quite the contrary. Harrison Woodill of our staff went out and shadowed one a couple of months ago and was duly impressed by the diligence of this price taker, the price surveyor. But for Pete's sake, I mean, the margin for error has to be substantial on these indices. And by the way, you never read about a plus or a minus reading on the so-called core PCE or the headline CPI, right? They don't say it's within 0.5% margin of error as they do on political polls. Having been shamed, the pollsters, into saying that, but what they say is that the core PCE is whatever it is, 1.6874, and I have seen this. Perhaps you have too, Evan, out to 3 decimal places. 3. 1 beyond the decimal point to me is kind of a conceit. 2 is pushing things. 3 is unacceptable. It's like a fund of funds. Anyway, I'm almost done with my rant, but the only thing I think I can definitely claim, and even this is a speculation, the only thing I believe I can definitely claim by way of constructive contribution to the monetary discourse of this country is the absence from these press releases of the phrase foreseeable future. When Alan Greenspan was chairman of the Fed many years ago, Grants got on the Fed's case about this phrase foreseeable future. What is foreseeable? By them, by us, by anybody? What, 2 weeks? Oh, no. Is it going to rain tomorrow? That's not foreseeable. Your phone's going to tell you it's going to rain, but the phone is going to change its mind, I bet you.
I think the Fed's dot plots, which predict inflation, go out 2 or 3 years in the future.
Yeah, right, that one. Or the five-year imputed forward inflation forecast derived from the derivatives markets. That one's a good one, too. Anyway, Evan, help me get off this particular one track. What else we got today?
Well, there's currencies not controlled by central banks.
Well, you're talking about gold, are you not?
No, I'm talking about the electronic emissions of initial coin offerings.
Well, I mean, they are, many people believe them to be the new gold. I'm sounding scornful. It's not scorn, it's envy. Envy of the recent price action, but I must say, I do not believe that these coins are, and by the way, there are about 825 of them, or were. They breed like rabbits. But I am not, I don't believe that it's a monetary phenomenon. I believe that it's a speculative phenomenon. I believe that these coins, whatever purpose they serve, and I have no idea really what blockchain is about, nor do I have a clear notion of how it will be used in the future, but say the blockchain is in fact the miracle technology it's meant to be. I don't see that these coins are stores of value. In fact, Evan, you observed something this morning in the headlines that would seem to say that some of the insiders in the crypto world doubt that these things are stores of value, at least not as stored as they're stores of value either.
Yeah, so this comes from Quartz. The website is qz.com. The headline is, after a series of hacks, cryptocurrency issuers may turn to old-fashioned bank vaults for security. The people making cryptocurrencies don't seem to really trust them.
Yeah, well, they're not going to hack my gold. They may depreciate it in price, and they certainly have over the past few years, but at least I'm safe from hacking. Evan, Eric, Phil, thank you for being a part of this particular production. And ladies and gentlemen, I thank you for listening. This is Jim Grant on behalf of Grant's Interest Rate Observer. We will talk to you next week.